Welcome to the deep dive. Today we are cutting through the noise on the Q3 2025 earnings call for Mohawk Industries, ticker MHK.
That's right, the global flooring giant.
And our mission today is, well, it's crucial. We need to unpack a huge contradiction.
A really big one.
How does a company post a solid revenue quarter, generate amazing cash flow, and still see the market just punish the stock?
It's the classic "what have you done for me lately" problem.
Exactly. So we're going to focus on that forward guidance, their really aggressive cost controls, and this whole thesis they're building around a housing market recovery.
It's a textbook case of market tunnel vision. For Mohawk, the street looked only at the next 3 months and completely ignored the operational discipline of the last 9.
So let's start there. What did the Q3 headline numbers actually look like?
They were surprisingly good, given all the headwinds. Net sales came in at $2.8 billion.
Okay.
That was up 1.4% year over year, and it was actually a little bit ahead of what analysts were expecting.
And what about earnings?
Adjusted earnings per share, or EPS, landed at $2.67. Now, here's a little divergence for you.
Oh.
That was a small beat versus the FactSet consensus, but it missed the Zacks consensus by just a penny. So, basically flat. GAAP EPS was much lower, around $1.75.
So a revenue beat, EPS that was, let's call it resilient, but here's the number that really stood out to me. The cash generation.
Oh, absolutely. The free cash flow. They generated about $310 million in the quarter.
310 million. I mean, that is phenomenal cash generation in a downturn.
It really is. And they even put some of it to work, buying back about $40 million worth of their own stock.
Okay, so operationally sound, cash is pouring in, but the market reaction.
A total disconnect. The stock traded down sharply right during the call and, finished the day down almost 7%.
And that cliff dive was all because of the Q4 guidance.
100%. The guidance for Q4 just didn't have the optimism investors wanted to see.
All right, let's unpack this then, because you have to ask yourself, is this guide truly a disaster? Or is this just panic punishing a company for things they can't control?
Well, it was definitely a punishing guide. Management guided Q4 adjusted EPS to a range of $1.90 to $2.
Right. And where was the street on that?
The street's midpoint was sitting closer to $2.13.
Okay.
So that gap, that was enough to completely overshadow everything good about Q3.
A 13-cent shortfall. That tells you demand must have weakened more than even they expected coming out of Q2.
That's what they said. Consumer uncertainty is the big one. People are holding off on those large discretionary remodeling projects. The consumer is just waiting.
But here's what's so interesting. They still managed to outperform even with that weak demand. How?
It's all about product mix. Their sales really benefited from the success of their sort of premium residential and commercial products they've been launching.
So they're selling better, more profitable stuff.
Exactly. And that helped them beat the overall market performance in most of their regions.
That's a huge testament to their product cycle. But if the market is going to punish them for interest rates, what are they focusing on that they can control?
Costs, and more costs. They are leaning in hard.
And already had a big goal, right?
A huge one. They were already targeting $110 million in total savings for 2025 from things they'd already announced.
And then on this call, they doubled down. They found more fat to trim.
That's right. New restructuring opportunities. And this isn't just, minor tweaks. They're rationalizing assets, streamlining logistics, and their admin functions.
What does that add up to?
These new actions are expected to bring in an additional $32 million in annualized savings.
And at what cost? Restructuring can be expensive.
And that's the impressive part. It only requires a net cash cost of about $20 million.
Wow. So a $20 million outlay for a permanent $32 million gain, that's a great return.
It's incredible discipline. And if you look out a bit further, all these actions together are expected to have a $60 to $70 million favorable impact carrying into 2026.
So that's not a one-time thing. They're building a permanent tailwind for when volume finally comes back.
Precisely. And they need it because the performance across their different business segments is, well, it's really uneven.
Okay, let's break that down. Where's the strength?
It's in global ceramic. That segment has a lot more commercial exposure, and it's holding up the best. Sales were up 4.4%.
And the margins there?
Adjusted operating income was 8.1%.
Yeah.
Now, that was a slight decline, but they said it was mostly offset by productivity gains and that favorable product mix we just talked about.
What's driving that resilience?
It's the institutional side. Think healthcare, hospitality, education. Those sectors are way less volatile than, single-family home remodels.
Okay, so that's the good news. Now contrast that with the pain point, flooring North America.
Yeah, sales there were down 3.8%. This is the segment taking the direct hit from the slump in residential construction.
Is there anything working in that segment?
There is, actually. And it points to their innovation, their specialty stuff, like luxury vinyl tile or LVT, and their new waterproof laminate collections. They continue to see positive gains.
Interesting. So if you have a unique product, people will still spend.
It seems so. Then finally, you've got flooring rest of the world. Sales there were up 4.3%, but the growth wasn't coming from their core European flooring business.
So where did it come from?
Their insulation and panels business.
Yes, sir.
It's a classic diversification play, a smart corporate hedge that provides stability when your main market is slow.
Okay, here is where it gets really interesting for me and where all the uncertainty is. The tariff landscape. This is a huge headwind.
It is a massive financial headwind, and they actually quantified it for us.
What's the number?
The annualized unmitigated impact of tariffs on their imported products is around $110 million.
110 million. When you put that against the 300 million in cash flow, that is a huge recurring cost.
It is. They said the average tariff impact is about 20% on those specific goods.
That number alone probably explains the entire cautious Q4 guide. So what's the plan? What's the defensive strategy?
It's a two-pronged attack. First is supply chain optimization, basically moving sourcing around to avoid the highest tariffs.
And second,
Selective pricing. They've already announced price increases of 5 to 10% on the products hit by tariffs, plus another 5% on carpet for inflation.
but pricing takes time to stick. How fast can they actually pass that through?
Well, that's the key question. Management thinks it'll take until early next year, so Q1 2026, for the market to sort of equilibrate and for those price hikes to fully offset the costs.
So that lag is exactly what Q4 guidance is reflecting.
Yeah.
Near-term pain before the pricing power kicks in.
Exactly. But there's a fascinating silver lining here.
Go on.
For anyone who doesn't follow flooring, the big battle is between LVT and laminate. Well, Mohawk specifically called out how reciprocal tariffs.
Meaning tariffs on products coming into the U.S.?
Right. Those tariffs on imported wood and laminate should actually benefit Mohawk's own domestically produced waterproof laminate.
So it's like a government-backed advantage against foreign competition.
It's a huge strategic advantage. It positions their homegrown products really competitively against imported LVT. It's less about margin repair and more about winning market share for the long run.
Which brings us to the big picture. The market is looking at Q4, but management is clearly looking past that to the housing cycle inflection point.
And the foundation they're operating from is just undeniably strong. You cannot ignore their balance sheet.
What's the leverage look like?
Gross debt is only $1.9 billion, and leverage is sitting at an exceptionally low 1.1 times debt to EBITDA.
1.1 times. I mean, that is an ironclad balance sheet. That gives them so much flexibility.
While rivals are struggling, Mohawk is sitting on dry powder, ready for M&A the moment the market turns. And they do expect it to turn.
What are the signals they're watching?
First, a global shift. Central banks are starting to pivot from just fighting inflation to, encouraging growth. Lower interest rates should gradually boost home sales and remodeling.
And that plays right into their long cycle thesis.
It does. They kept saying this downturn has lasted over 3 years. That has created a ton of pent-up demand for remodeling projects.
And they had that great data point that people spend 5 times more on flooring in the first year after they move.
5 times more. That pent-up demand pool is massive. When it comes back, the floodgates open.
And they see 2026 as that turning point.
They called it a transitional year. They expect much better results driven by innovation and all those cost cuts we talked about. When volume returns, it'll hit a much lower cost structure.
Which means margins should accelerate and fast.
Very fast.
Mhm.
And one quick calendar note for anyone modeling this, Q1 2026 will have 4 extra shipping days.
That's a big deal.
It is. They said it could boost sales by 6 to 12% year over year in that quarter alone. But Q4 2026 will have 4 fewer days, so you have to keep that shift in mind.
All right, as we move to our final segment, we have to give our universal disclaimer. This is not financial advice. We're just exploring the strategic possibilities that come out of this call.
And given the strong operations, the cash flow, and the fact that the stock got hammered on a single quarter's guidance, well, the setup for a long-term cyclical play is pretty compelling.
Okay, so here's the outrageous but plausible trade idea. The company is managing everything it can control costs, cash exceptionally well. They're sitting on a fortress balance sheet.
And the stock has been punished. ignoring that whole multi-year pent-up demand story.
So the trade is a bet that 2026 is truly that transitional year where all that operational discipline finally meets returning volume.
And the proposed action would be, to go long the stock here using this depressed price as your entry point. Or for more leverage, you could look at deep in the money, long-dated call options or APs that expire in early 2027.
The whole idea hinges on massive operating leverage. You're betting that when housing finally turns, you'll get huge multiple expansion.
And with leverage at only 1.1 times, they are perfectly positioned to reward shareholders through buybacks or M&A the second that cycle turns.
So to summarize the key tension here one last time.
It's good operational execution and very strong cash generation in Q3. But the market is just fixated on the near-term Q4 margin headwinds from tariffs and soft demand.
So what does it all mean for you, the investor? Management believes they are set up for multiple years of above-trend growth once that housing inflection point is finally hit.
And here's a final thought to leave you with. Mohawk has locked in about $110 million in permanent structural cost savings for the coming years.
Right.
So how fast will their EPS accelerate if housing turnover just reverts to its historical average after being depressed for 3 years? The leverage on that optimized low-cost structure could be absolutely enormous.
That is the multi-year story. We encourage you to continue your research and connect those dots. Thanks for joining the deep dive.